off the bat, I wanted to clarify with you some things that have been a hot topic of discussion in regards to YieldMax funds. There's a lot of speculation that you guys might be doing some new things to stabilize the NAV. And I've seen talk that it's like people think they're noticing it in a lot of funds. And those three things are adding swap agreements for direct asset exposure, integrating deep in the money call options for stable premiums, and then allocating capital into actual equity holdings. So speak to that and let me know if that's being done, and if so, on which funds.
Yeah. Okay. So we did make a few filing changes for MSTY that had to do with those three potential changes to the long equity exposure, right? Today we use the hey Rod, how you doing? Today we use the synthetic to create our long exposure, but with potential challenges next year. This is a 2026 thing, so we're just getting ahead of it. With the potential challenges next year on contract limits, or like the number of the position limits that you're allowed to have in a fund like Misty, which is the largest YieldMax fund. We just wanted to get ahead of it and give ourselves a few choices. I'm not even going to say options. Give ourselves a few choices on how we address potential limits. And so there's actually a few other ways that we'll do it. So when you add in the ability to hold stock or use swaps or use deep in the money calls instead of the synthetic, what happens is that just wasn't in the prospectus. And so we filed that. I think it was only for Misty. Maybe it was NVIDIA, but those are, two of our biggest. We haven't actually implemented any of those tactics yet because
really
I haven't needed it. Yeah, no, there's no swaps in Misty. There's no long stock in Misty. There's no deep in the money calls in Misty, right? So none of that has actually been put to work. We just made a filing in case we wanted to make those changes, and we had a position limit challenge. So look, I love that people recognize that we made a change to the pro, but nothing has been changed yet. NAV stability. I like that you mentioned NAV stability. An up market sure helps NAV stability, right? Like
that's what's doing it.
Hey, market going up. Hey, these are covered calls. They're bullish. Oh my gosh, I love it. Right? Like that's what's doing it. You got it exactly right. So yeah, I'll try to make more option puns as I could do it.
You walked right into that one. That was great.
Yeah, I know. Lots of options with options.
Yeah.
Option fund.
So rumor has it Tesla paid one of its lowest dividends ever. Thoughts on that?
Sure. I don't know if it was one of the, it definitely was a low one. Vol's down, right? Implied volatility is down. Nobody should be surprised by the implied volatility being a factor of the distribution rate. Like that, how many, right? You know this, right? We've talked about this a lot of times on our previous videos, that the implied volatility defines the amount that we are going to distribute, right? Like that's where we start. That's what we sell our options for. That's our income rate. And, tests, by the way, many stocks are at a significantly lower implied volatility than they were before. Most notably, and not to bring it up again, is Misty, right? Like MicroStrategy, MSTR's vol is the lowest I've seen since we launched the fund, and actually even before that. So, I'm not telling anybody what the dividend is, but I'm just repeating what we've always said. We always target the implied volatility as a driver of the distribution rate, like since day one. So when you have a low vol, you're going to get a low distribution. That's all there is to it.
Makes sense. And so far, there's only ever been one reverse split, and it was for Tesla.
Gosh, and how upset was everybody? Do you remember that? Everybody lost their mind on that.
They're so upset. It's never happened again.
And we're like, okay, we listen. Yeah. We'll do it again. Like, what's the price of MRNY these days?
I was just looking at it. $222.
Right? AIYY is under 5, right? So, like, look, we won't, we won't do it unless we have to at this point, right? Because it was such a dissatisfier, to our investors. Again, it makes no difference to the performance of the fund. It feels, I know it doesn't feel great when people take a look at that. So, oh yeah, that's That's a fun one. 222 spot 22. If
At
I
least
can
for the
comment,
numerology people, it's aligned.
is that a good luck one? No, eights are good luck, right? I think eights.
I think so, but it's like repeating numbers or something. I don't know.
Yes.
At this point.
How many digits of pi can you recite?
Right.
I was just to complete my nerdness here, right? So I'm not going to repeat how many digits of pi I can rattle off. But I was going to bring something up here. So this is a great example. No one really ever talks about this, but this is a great example where actually pull up a Moderna one. Oh yeah, that's so not our fund. Just pull up Moderna, mRNA.
Stop.
Right. Yeah. So take a look at this guy. Right. So go back. Whatever. Not today. Just go back. Do like a 1 year on this guy. Mm-hmm. So when you look at the stock, right, look at where it was trading and look at where it has dropped. Right. So just the price alone on the drop on this thing is what's driving the decline in MRNY. Right. Because a recover call strategy, dropping prices, dropping fund. This is why we now launch at $50 instead of $20, right? So Moderna, when we launched, was probably even more than what you have there at 150. But if a stock really gets hammered, it really pushes down the price of the YieldMax version of the ETF. So what happens is, it didn't change anything, but we said, well, look, like if a stock loses 75% of its value and we're doing a YieldMax on it, we're going to go from 20 to 5. Even just following the down move of the stock, right? Because remember, all the income we make from the cover call strategy, we distribute. So you get all the down move in that scenario. Net is less loss. Don't get me wrong, right? Total return is less loss, but our ETF NAV will drop. So going with a higher price means you don't have as many, $5, $10, $3 ETF. YieldMax ETF prices anymore. So I only bring that up as Moderna is like the perfect example of why we now launch at $50 instead of 20, which is how we started in early on 2022, 2023.
So can you explain that again to the audience? Because that's been a common question. Why are we launching at 50 now versus 20?
Yeah, again, it's just to keep the NAV price a little higher, right? So first off, we started talking about reverse splits, right? So you reverse split because the share price gets too low. Maybe brokers don't let you margin it. Maybe, people don't want to hold it in a portfolio when it's, $3, $4. So in order to avoid that happening, we start our initial listing at a higher price at 50. And so if there is a 75% decline in the underlying stock, we won't find ourselves at the $2 to $3 rate like we find with what happened with Moderna and Murni, right? MRNY is at $2.22, mostly because Moderna has dropped from $150 to $20, right? And that's a pretty bad drop. So yeah. That's kind of why we go through that, why we launch there.
Interesting. Yeah, good to know. That's come up very commonly on here. So you'll be glad to know. So we've gone from YLT no go up to now we have the biggest fan of Ulti on. This guy, he's like the biggest fan of Ulti. He thinks it's like the greatest fund known to mankind. So he says Ulti has an admirable increase in assets under management. Why is it trading team not using the increase in shares to safely stagger higher covered call strikes and volume? There are 3.5 million losses that are avoidable.
All right, so let me connect the dots here. So they're connecting AUM.
I said he was a fan. Sorry.
No, that's okay. So no, it's fine.
Yeah.
So by the way, Ulti definitely has been getting a lot of attention lately. I saw a funny meme today where it's that one, where the guy's with his girlfriend, but he's looking at the other girl, and like the existing girlfriend is Misty, and the one he's looking at is Ulti. I think you can probably find that meme somewhere. I thought that was pretty funny. So if I'm trying to answer this question here, why is the trading team not using the increase in shares to safely stagger higher cover call strikes and volume? Okay, so that means I think what Earth here is referencing is, hey, you have new money coming in. Why aren't you putting higher strikes with the new money that's coming in? And we do for sure, right? Like I have Ulti up right now. I'm looking at our coin position. I'm looking at our Circle position. That's a fun one. Good job on the team putting on Circle. I'm looking at, let's see, which is another one that we added to recently. HIMS has higher strikes. IONQ has higher strikes. MicroStrategy at 140 now. Oh, sorry, that's NVIDIA's 148s, 144s. Yeah, so we are, and we're actively rolling these. So we will, from time to time, when new money comes in, assess, hey, should I use the existing position as my new strike level, or do I have to set a new one because the call is just too close or the call is in the money? So we will do that. Again, we do, right? So a couple examples that we're doing. The other thing I would say are there are 3.5 million losses that are avoidable. Look, when a short call loses money, it means your long stock made money. We are normally okay with short calls going in the money and rolling up. You'll see the ulti managers rolling those calls fairly regularly once we've earned our time decay. Actually, because we're talking about Circle, right? Circle is an interesting one. I mean, that's like all the rage these days, right? I mean, the thing IPO'd at 30, then you could first trade it at 50, 60, 70 that day. It's now trading at 240. To have have a stock like that in your fund, you're constantly rolling up, right? So, we're in the 210s, 200s, 190s. So we're constantly kind of, as money's coming into ulti, adding new strikes as we're rolling up and out. So I think we are doing it. We don't do it for every single position, but it is absolutely something we consider.
Okay, that's good. I noticed you've got these European funds now.
We do. Sure.
Yeah. It's hard to keep up with all the funds you're launching.
Well, look, there is a whole team here, right? Like this is one of those things that makes just a lot of sense. I mean, trading now, I think my trading team's got 25 traders on it, right? Mm-hmm. I think the management team of YieldMax is, now been more, I don't want to say aggressive. That's not the right word, but open to launching funds on different exchanges in different countries, right? So some stuff in Japan, Korea, Mexico, Europe, right? So it's just the demand is there, but because a lot of those, some of those countries can't buy U.S.-based securities, you need to put it into the, to the exchanges where they are. Now, things are always a little different in each one of those places, but, the original is still what's here in the U.S., of course.
So speaking of European funds, there's a lot more like triple leveraged funds in Europe. Because we're not able to do that in the U.S. anymore. It's all, I think 2x is the max. So with that being said, are there any plans to do? So I know all the fund companies are starting to I don't want to say copy each other, but everyone that's doing like these high yield dividend covered call ETFs are all trying to find new angles, incorporate new strategies and things like that. So there's another company you probably know about that is doing like high yield on leveraged ETFs. So were there any plans for you guys to do that too?
So we looked, sure. It was early on looking at those. If you look at the performance of some of those, there's some we talk about, everybody calls what I call NAV decline, NAV decay with YieldMax. It's not, there is no NAV decay, right? NAV decay is really relegated to futures-based products that have to do with the decline of contango and leverage products like what happens with negative compounding. So we shied away to a degree from that with some of our products because we thought, look, you already have this problem of only getting limited upside with the covered call build and 100% of the downside on the decline, right? You have stock risk. So, the attractiveness of a double product is not income, it's growth. And when you apply a covered call strategy on the whole piece, you will inherently limit your upside. And yes, you're going to get some premium for that. Don't get me wrong. But you now have two reasons why your NAV can decline. So we stayed away from those generally. Now, I know there's some folks that are kind of doing mixes, and I think that's probably a smarter way to do it, right? Like, hey, 200% on the stock, but only selling calls on half, right? I've seen some of that. That also can make some sense. But generally, we've stayed away from the leverage piece. But the other comment about, hey, there's, you've got some competitors in the space. It's true. And I think that's actually good for the market. I think it's good. I think you gives validity to this, what I'm calling a new asset class that YieldMax is defining, right? We haven't really talked about that, but you think about, because we're talking about leverage, you think about the birth of leverage ETFs in like '05, right? That period, nobody really knew what those were. Nobody understood what they were. They're like, oh, it's a bunch of leverage stuff. It's like futures. Nope. You have to understand the dynamics. These are trading vehicles, right? Those were trading vehicles. So you have to look at charts differently, right? Same thing here with YieldMax and super high. I'm going to come up with a better name for this. This ultra dividend, ultra distribution, or whatever we're going to call it, where you have this 50, 60, 100% distribution rate. It just, you have to look at things a little differently. You have to get educated about the dynamics, and then you have to know how to review the price of that and understand the price moving. It's funny. Somebody told me the other day, they were like, "Wow, I don't know why everybody's so interested in Ulti. Like that price is down 70%." It's like,
I was actually saying the same thing.
You gotta look at the total return, right? And it's hard to find a tool online that's free for total return, right? So it's one of those things that the world just
seeking alpha is what I use.
Yeah, and they'll do it. By the way, Seeking Alpha will do that, right? You get total return. I see their total return charts all the time.
Yep. That's, I mean, every video that I do when I talk about it, that's what I'm putting in.
Yeah.
While we're at it, let's look at that. But anyway, any plans to launch any leveraged ETFs?
For YieldMax, I do not believe there's nothing we've filed there, right? So I can't talk about something that we haven't filed for, but nothing that we've filed for YieldMax now for leverage. Did we file leverage? I don't think we filed for any leverages. No.
Yeah, the total return is positive for Ulti. I see that.
Yeah, like that's like, oh, you're actually up. Oh, but your price is down. Like, yes, there's a difference here because like it's silly to not include the dividend, right? To not include the, the quote unquote yield. It's not true yield, but it's, the distribution rate. It seems silly. So it's part of the investment, right?
Right. Are you guys updating your return of capital more regularly now? Like I know a lot of people were like,
waiting. It's even in the announcements now, right? On those weekly announcements, there's a column now that has return of capital in it.
Yeah, I thought I did see that.
Yeah.
Off topic though, the thing with leverage. So like if you look at some of these leveraged funds, long term, they're up like, I want to say TQQQ's up like 17,000%. But sometimes when the underlying drops, the underlying stock could then recover, and then the underlying still lagging behind it for like a year or 6 months. The leverage
again, there's that compounding effect, right? It takes a lot more positive movement, right, to catch up. I'm sure. Like I don't want to go through a session on teaching people how leveraged ETFs work necessarily, right? But just you should understand that. Put in a spreadsheet. Just do if the 1x, the regular is up 5, down 5, up 10, down 10, up 15, down 15. What's the result? And then do that exact same with a triple leverage and just look, and you'll see that the difference in the more volatile the underlying, the bigger the lag against things like break even or upside capture.
Right.
Yeah. It's just math though. It's just math. It's not because those funds are doing anything wrong. It's just unfortunate. It's negative compounding, which is why those are trading vehicles versus, buy, hold, or buy in, drip, right? Which is what we talk about with YieldMax all the time.
Right. Exactly. So Earth Creature said my comment about him being the biggest fan was highly inappropriate.
Highly inappropriate.
So I'll send flowers or something.
Apologies.
Apologies. Ulti stabilization is great, but those CC strikes getting blown through weekly is just alarming.
It's okay, right? Like we don't hate that because income is the first priority, right? So we do all the market's going to give you what it's going to give us, right? We will set strikes where we look to capture our income rate and capture as much upside as we can after that. But you'll also notice that we're very active in rolling those strikes up and out, right? They are not set it and forget it.
Right. Let's see here. He said, isn't Ulti capable of ordering calls for upside now?
Ordering calls for upside. So adding like long calls, yes, we totally can. we talked. But what you'll also notice in Alti is there's a cost for the puts. So one of the things that I think the most stabilizing factors for Alti has not been necessarily the up market. It has been the protective puts that we're using on those positions, right? I can't tell you how many times that has protected us since we started adding those. And if you were to do a year to date, I don't know what this is going to look like necessarily today, but do a year to date of Alti versus the Qs. If you could do that again.
Yeah, certainly.
Yeah, on the total return, if you can. And what you'll see is that the downside capture is fairly similar to the Qs with the protective put. Meanwhile, the volatility of our stocks is significantly more. There you go.
Over how long?
Yeah, well, that doesn't look like total return though, right? So
here we go.
There you go. Yeah, total return. Oh, sweet. There you go. Yeah, and so what you'll see is, right, Alti is outperforming a little over the Qs, for this time period that you have pulled up here. So this is that's the last year. If you look at year to date, right, click on the year to date, you'll see it, Alti's up 5.4 versus 4.3. So it's one of those things where, like the offsetting the risk with some protection is a cost. So you have to think, is it better to buy the upside calls? Because every time I buy an option, I'm killing premium, right? I'm eating into the premium of the calls that I sold. So it's one of those things that we defer to the price stability these days, but upside growth is definitely a part of it still. So just talking about the stability there, yeah, it's considering the volatility of the underlyings that we have. So we're kind of muting the move, but still able to harvest a lot more out of the market, right? So the Qs, if you were to sell calls on the Qs these days, you're getting 20, 30%, a la YQQQ, which is the inverse, but still, you're not even getting close to the 80% we're doing with Alti. But yeah, we have the volatility of the Qs, which is 4 times less. So there you go. We got to get you a phone stand or something, man. Like you're really
I just screwed this up here. That's why I got a new MacBook. I just got to set it up because all my sound and stuff in the MacBook Air is shot. It's great buying products, for like top dollar, and then they don't last you 5 years.
All right, I just saw the greatest comment I ever saw from Mike.
Really?
Yeah.
Oh, this guy. He's a clown. He's one of my longtime fans. He's always cracking jokes.
That's funny. I hope you notice I lost 20 pounds. I hope that's what he's saying here. That's what I'm saying.
So these guys have basically been cyberbullying me for gaining weight. So they use AI. So I don't think I'm that overweight. I'm probably 20 pounds overweight, but they use AI to make pictures of me like looking obese. And I play kickball on the side. So this guy, I'm going to call him out. He's uses AI. Then he's got me playing because I do kickball, and he says, "Oh, kickball season's over." He's got me playing like in Special Olympics basketball or something. He's a meanie.
No, he's not being nice. The internet's full of it. What do you want to do, right?
Oh, I know. That's what happens when you're in the arena.
Sorry, Mike. Now I'm not a fan, Mike. If you're picking on Coach,
that's what you sign up for, right? He must know that though, because he mentioned, yeah. Anyway, we'll try to save the silly questions for at the end. Since April, the market has run up. Do you have any strategies that will make Alti price appreciation on your calls for Alti? What's the delta?
Yeah, again, it's all based off of our income target first and foremost, right? So when we're putting on a position, the more volatile the stock, the more upside we're going to capture because we could sell premium farther away. So in those situations, the delta will vary, right? It's not always the same, right? The delta on Coinbase that makes us 100%, let's just round to that, is going to be different than, let's just say, just looking through the portfolio, the Upstart, right? That's going to have a different volatility. So, I would say that that's always our defining factor. Define your income, hit your income target, then do your upside. So I'm, fairly consistent with that messaging. There are other tactics. At times we've done this, and it's been 50-50, where we'll put on like what I'll call a convexity call, like deep out of the money long call, paid for by selling deep out of the money short puts, right, on a stock around earnings, right? And sometimes that's worked. We'll buy a 10 delta call and pay for it by selling a 10 delta put, right? So really stretching that out. And so from time to time we'll do that. It's worked a handful of times. I think one time it worked really well for us on Tesla, but it's not a tactic we do all the time. But that is within the so if you know what I'm talking about, right? Convexity is where you have a put that kind of a call that expands faster than the growth of the stock, right? So if the stock's up 5%, your call may go up 5. Then the next 5, your call may go up 10. And the next 5, your call may go up 20, right? That expanding upside capture rate is what's known as convexity.
That's the appeal for people that buy calls for like quicker gains.
But they're riskier, right? They're super speculative, right? Because
they are. I've lost money on them myself.
Yeah, but look, when they hit, you get 9 in a row wrong. That 10th one pays for the other 9. Maybe.
That's exactly how it's gone for me. But you got to get out of them quick, because if they go up, I just had one that was up, and then I waited like a week. I got greedy, and then boom, stock dropped, and it was done.
Take half off. Take half off is always a good thing, right?
That's or get your money back at least. Like lock in your money, and then
there you go.
You're playing with the house's money after.
Yeah, exactly. So, so I think those are tactics that we may deploy from time to time. It's not all the time, right? They're just opportunistically picked.
Yep. Okay, let me try to go in order here. So this guy was nice enough. I actually pulled his question from Discord, but he was nice enough to post it here. He said, does Jay run back tests on the strategies internally? Curious, what do the back testing results for QQQY, SDTY, and other index-based ETFs suggest long-term viability and profitability of strategies?
Yeah, so yes, we have done back tests before you launch a product. That just seems, sensible to do. But I would say we don't run it on every single ticker. So for example, originally with Tesla and OARC, our first two, lots of back testing that went on. Once we actually we ran them independently in house accounts for 6 months before launch. Just to get a feel for like what the day-to-day dynamics are going to be in them. And then once we were live, we were like, fine, and we followed that process. But so that means we didn't run back tests for, I don't know, the recent ones that we launched, right? Whether it was Hood or Carvana, because we know the process, right? Or Berksey, right? We know the process for these, right? So we're not always running constant back tests. But then as you launch different products, SDTY for sure, that is a product that is a zero DTE product, meaning we're long calls. You don't sell a call the night before, you sell a call in the morning. Lots of back testing on that guy. We think that the methodology we're using there, which, all of our trades get posted. So you can always see that in the morning, and then actually how we roll during the day as well. We think that methodology has a chance, and I wouldn't normally say this about covered call strategies, but has a chance to outperform the index. So there's some periods of time where that fund has outperformed the index, right? Same with QDTY or RDTY. Those are the zero DTE strategies. But I'm starting to feel, by the way, and I'd love to hear from the community on this. Does the zero DTE, moniker matter anymore, or is it really just about performance, right? Do you care that we have made our money by selling 5 calls throughout the week, or you sold 1 call once a week and you made the same amount of money? Does it really matter that there's this zero DTE component? Now, it does matter, I think, when it comes to the tactics, but does the name, zero DTE even matter anymore? I'd love to.
Yeah, I think the name and the exact number of calls are very important to the fans.
Yeah.
I'm kidding. No, as long as you're making money, they don't care.
Yeah, I mean, that's, but look, and it's supposed to hint at a style, right? When you say the zero DTE thing, it hints to a style of, they're selling calls in the morning, or, it's a one-day trade. Let's see how it does, right? But anyway, that's all, I think people have, it seems to be the shine has come off that zero DTE moniker a little bit, but, but it doesn't matter if you're producing positive returns. Great.
Absolutely. And I know most of the audience is a fan of the 0 date to expiration because it's really boosted the returns. At some of the, I want to say Roundhill, they were like performing exactly in line with the S&P and paying the weekly dividends too. And you guys have your own.
That SDTY is like that's an example, right? And I would say they have been lower adoption than I would have expected, but we felt, look, we're YieldMax, we have to do these, so we wanted to make sure that they were in this, another arrow in the quiver, so to speak.
Absolutely. Can you explain something further that you said a second ago about how one of the covered call strategy funds might actually outperform the underlying? That's very interesting.
Yeah, it can, right? You can, depending on how the market dynamics move, you can have a period of time where you can, by selling calls at, to Earth's comment before, right? If you could sell calls at a high enough strike where you never have to cover it a debit, yeah, you can outperform the underlying. It seems to work better on the indexes than the individual stocks. The time where the situations where it's really, really hard, and I think if it wasn't for this one day this year when the market went up 9% in a single day, we all remember that day. Generally the 0 DTEs can outperform the underlying index. But in a total return perspective, right? I think we've seen some evidence of that in the past. And so, a 9+% day is going to cap any covered call 0 DTE strategy. Like nobody's selling calls 9%.
Right, it's going to blow it up. It's going to blow it up. You're going to have to roll it. And
like you're covering that thing, right, for a loss, right? Or you're actively doing it throughout the day and paying and selling for new ones. But if you take that day out of the mix, I think you would look at these 0 DTEs, and this is worth somebody doing a study. You can, and that's something that I would do and put out. Compliance would never approve it. But if you took a look at, the day to day comparatively and take out like one or two of those really big popping days, I think you would see that the total return of these funds can outperform the index. Can. No guarantee, but it can.
That's great. I mean, the fact that it can, that there's that capability. That's
generally with the YieldMax suite, I would say you should expect to capture on a total return basis 75% of the upside of a stock. Look, if you wanted all the upside of a stock, just buy the stock, right? We all know YieldMax is about earning the distribution or getting paid the distribution. So it's a different strategy than just being long the stock. But I think with the indexes, you get a little bit of both. And a lot of the back testing that we do was designed to try to fine tune the dynamics and the intraday trades that would let that happen.
Mm-hmm. So Rod is excited for CRCL launching.
Yeah, this is, there's been, so CRCL, obviously Circle's been, we already talked about it, right? How it's in all.
Yeah, you did.
And same thing I'll say with CoreWeave, right? These are two super hot stocks right now. Want to have a YieldMax on those as soon as we can. There has seemed to be a little more. So previously, you couldn't launch a single stock fund unless the stock has been trading for a year. Right? I forgot exactly what the right terminology is there, but you have to wait a year before you can be live. That has
wait with what?
Before you could go live. So the reason we don't have a Reddit fund already, right? Is because we have to wait a year before you could file for
it to have been public for a year.
Yeah, So it had to be IPO at least for a year, right? Trading on the markets for a year. So Circle's obviously like what, 2 weeks old at this point, right?
Yeah.
So it's one of those things where there has been some difference of opinion here of whether how strictly that's going to be enforced. But I will tell you, we are actively, we should be, as we, you would imagine, we're actively looking at some of the IPOs in the marketplace to figure out the best way to get, YieldMax filed on those.
621% in 2 weeks.
It's not bad.
Yeah, I'd take that. All right, let's see. Okay, so Earth Creature appreciates that you said you echoed his sentiments about math. So that was good.
Math is good.
Yeah.
It's just the math.
Absolutely. Okay, we've got a lot of questions lined up here. Let me try to navigate through these.
All right.
Let's see. Sydney Simon. The prospectus has been updated for Misty and NVDY to include swaps and holding the underlying. They still don't appear. We talked about this. Yeah, when will this happen?
Yeah, it's only, again, it was more of a preventative, be ahead of like potential size limitations of our option limits. So this one is, we haven't added those. They will not change the performance at all. Maybe slightly because a swap is a little more expensive than the synthetic. The deep in the money call could be a little more profitable because you still have some treasuries paying you income and stock is stock. But when we start using them, they're not going to make a difference in the upside capture or really the downside capture, right? They are just all ways to get long in lieu of the synthetic that we're using today. No plan to use them unless we have to.
See, I thought when I was looking over Tesla and some of the others, I thought that I had seen some stabilization in the last month. So I just
the price has been fairly stable. You're right about the price, but I think that had more to do with the market than it had to do with
You're right, yeah.
us changing the positions. Yeah.
A bull market is great for no NAV erosion.
Bull market's good.
Yeah.
We like up markets.
So that's all we need. We just need the market to be up.
Just keep going up, market. Apparently every dip is bought, so that's all there is to it, I guess.
Mm-hmm.
I'm kidding. Sarcasm.
You've got to clarify sometimes because people take you seriously.
Jay said the market only goes up. I know one time I had some passing comment, like in theory, if we exceeded Misty Holdings, what we would do. And like people grabbed onto it and really ran with it. Misty's always Misty. That's all there's to it. That's it.
You're using the Jedi mind trick there.
Hopefully, yes. This is the fund you're looking for.
Okay, let's see. Did I ask this one already? Since April, the market has run up. Do you have any strategies that will make alti price?
Yep, we talked about that.
Yeah, we did. Yep. And then we went over the important topic of my weight loss here.
Yes.
He said it is a good tool as well. Thank you for that. Perfect.
Same comments here, right?
Yeah.
Upside, right? So again, it's the cost. We're paying attention to the cost of long calls and the cost.
Oh, he pointed out return of capital is not official till the fiscal year closes.
That is true. We do have to disclose it so you know it's coming. But you're right, and wait till the end of the year. Look at your 1099. It's probably going to be on the first or second revision of the 1099s out of your broker. So just make sure you're paying attention to that. Yes.
I feel like those forms were not available till March or something.
It all depends on your broker, right? Some were February, right? It all depends who you trade with.
Yeah. Because when I did my taxes, I was very thankful because I made a lot in dividends and I didn't owe on everything. it cut me a break, actually.
I know, like there's so much there's so much negativity around return of capital, and it's actually not really a bad thing for investors. Again, I think, if I could take 2 seconds on this one. Do I have 2 seconds? Yes. So
go ahead. And I want to preface what you're going to say, because the most common thing I hear is that, they're just giving you, like when you go over total return, they say, well, yeah, you're matching or maybe slightly under, but they're just giving you your money back. And then you're paying a management fee or an expense ratio.
Right. Okay.
Yeah.
So this is the about. We have actually met with the SEC to talk about things like return of capital and distribution rates and return rates and total return, like all of those concepts, to make sure we're all on the same page. So with option strategies, return of capital is very common, but it is only a tax classification, right? You're not actually getting back. That's not the way we view it. So let's say, for example, we have an ETF that's trading at 100 and we have an underlying stock that's also trading at 100, right? And I sell the 105 for $1, right? So it's the stock's trading at 100. I sell the 105 for $1, and the stock proceeds. And I'm going to make that dollar, right? We're going to make that dollar in time value, no matter what happens. We know the time value of that call will go to zero, whether the stock goes up or down. The time value will be worth zero, not the options, but the time value. So let's say stock stays the same or goes down. Great. You're going to have a that the call goes to zero. We're then going to distribute that $1 out in the distribution, and that is a profitable trade, and that is classified as income, short-term capital gain, right? You'll get that $1. Okay, great. That makes sense. Hey, but the fund went down and I got a distribution. Okay, interesting, but that's fine because you had no realized gains or losses on the long stock. But now let's say the stock goes up. The stock goes from 100 to 110. I'm going to have to buy back that short call for $5, right? Because it's all intrinsic value at that point, between 105 to 110. That's $5 value of the call. But I got $1 to start with. So my net loss there is $4, right? I lost $4 on that trade. We're still going to distribute the $1, right? But that $1, because there was a realized loss in the fund, gets categorized as a return of capital. Even though the underlying stock went up, you made the $1, but because the net realized trades of that day or that period were negative, right? Sold for $1, bought back at $5, lost $4. It's classified as return of capital. But you made money on the fund and you made time value and you got a distribution. From a tax perspective, that gets classified as ROC. It doesn't. We didn't give you back your money, right? You're actually up in that scenario, right? In that scenario,
yeah, you made money.
It was 100. You went up to, at that scenario, you're at 10. You're at 105 once it's done, but you actually made $6. The first $5 of appreciation and the $1 of income, right? So the fund would be at 106. We distribute $1 down to 105. So you got $1 in your pocket, a 105 NAV, but the distribution is return of capital. You tell me how we're giving you back your own money. We're not, right?
Right. Yeah, you're getting
that's the example of why there's so much confusion about the tax treatment of realized trades versus unrealized trades.
Right. So to that point, so this commenter, if the NAV trends down and I'm just getting back my own capital as income, is this really yield or just a prettier version of return erosion?
Yeah. So I think I just kind of went through a scenario where none of that is true. Yeah. So sorry, off. I would say that hopefully that explanation is clear. Look, it's a total return game, right? That's all there is to it, right? The whole thing is a total return. You're not getting back your capital. You're getting back the time premium we sold. We track every single time we sell a call what the time premium was, the extrinsic value of that trade. That is what goes into the distribution, because that is what helped us define the call strike in the first place.
Oh, he's putting you on the spot here. He says, is there any difference between you and a competitor company? Do you do active management on a daily basis or just open the position in the morning and leave it?
No, that's okay. I don't mind calling out. No, well, look, we are active throughout the day. We will trade. So this is in the 0 DTE products we're talking about. So I'm going to go take a look. I don't even know the answer to this second, because, but if we went to the YieldMax site, we should see if we were active in our trading during the day, or we just put on our calls on the 0 DTEs and didn't do anything. So I'm going to take a look real quick at those. Actually, yeah, if you go to the 0 DTEs,
we'll pull up. We'll pick on NASDAQ.
Yeah. Click one of them and scroll down to where you can see the intraday trade file. Right. So by the way, you can always tell, right? This is exact. So for those of you that want to know, like, hey, how can I tell what you guys are doing?
And not everybody shows the trades, by the way. I just talked to a fund manager yesterday that doesn't. Nope.
A lot of funds do not. All right. So right there in that intraday trade download, see that button above the positions? Let's open that. And let's see if we did any intraday trades today while the market opened high and then declined.
Yeah.
So open that.
So because of the amazing technology I'm using here, I'm just going to have to like repaste this into a Google sheet so we can see it.
That's cool. Yeah. So while you're doing it, I'll look and prepare an actual answer for what happened today. So right now, like, you're getting the data that that's out on the website. Let me open this up. Hopefully it's there.
Yeah, no, I see it. Let me see if I can get it on the screen here.
Yeah, you'll be able to see it in a second. So what you're going to see is that We had an entry. Well, we could pick on the S&P because that'll be the first one that you take a look at. So there's an original short sale of, meaning selling a call at the 60.25. So you're going to see in a moment for $7. We bought those back for $5 and sold for another $1.30 throughout the day to move our strikes up by 50 points. Right. So there's, as we know, with cover calls, you get your premium and your upside capture. That's the way you make your money. If we have the ability to roll our calls higher or cover our calls and pick a different strike, still have our net income for the day and elevate the call throughout the day, we will. Now, you never know, right, how the market is going to go. I would imagine we did this before the market really dropped during the day. But yeah, so we are intraday trading. So why do we do that? And look, by the way, we posted. So there it is. You can see the information that's out there when we trade this. So this is our way of being a little, different than Roundhill, who clearly has done very well with their funds in the zero DTE field. We think being a little more active can show a little bit more of our chops to the street versus just putting on a call and letting it, go. So you're really struggling with the technology. I can't share, can I?
No, I got it. So here's what happened.
There you go.
So I lost my student version of Excel on here. So I had to open a text file and then paste it into Google Sheets.
Yeah. So if you could expand column C, I think you'd actually be able to see you're missing the prices there too. I don't know. It doesn't look like you got it all. It didn't look like
the text file. You can see the ticker. You can see it's short sell, the 26, and then the 705.
Oh yeah, there you go. Right. So we sold 26 calls at 705. Yeah. So that's what I was just talking about. So the answer is yes, we are active. Again, a little bit of differentiation. We think this is actively managing, selling weekly calls, even intra-week calls. That's always been kind of the hallmark of a YieldMax.
All right, we got plenty more here. We got an LOL. That's perfect.
Thanks, Bob.
Does Pete Hegseth make you nervous?
Should I not say that? I don't ever even recognize that name, I guess.
He's the defense secretary. I think what he's getting at is all the Middle East stuff going on.
Yeah, I mean, it's look, here's the thing. I mean, obviously, besides the human challenge when it comes to everything that's going on, I would say when it comes to our option strategies, right, we let the market define, right? We let the market reflect how nervous the world is. We see that implied volatility, right? I would just tell you that we all went through April, right? And we all saw what happened in a very, very fast market, the declining market. I'll tell you, in my 26 years of trading, 27 years of trading, that was the second hardest market I ever had to trade. The first being, the 2020 decline in February and March with the pandemic. But
it was similar to 2020. I thought the March and April of this year.
It was to see a plus 9 day. The only other time I've seen a plus 9 day or 8 day was during that period. Same with the declines, right? So I mean, I remember at one point looking over at the TV and I was like, oh, we're only down 5%. That's fine. Like, how is only down 5 in a day fine? Like, that's.
But in that context, it's like, okay,
I was like, only down 5 is fine.
They halted trading today. We can't lose any more money.
Yeah, it's and we were close. Like that's only happened a few times. So I would tell you that yes, it's harder to trade in those environments, but we let the market define, right? We're not making a market call on it. I would say, with the exception of Alti, where we actually pick the underlying tickers, right? We're trying to pick stocks that are going to go up as well as have a very attractive option profile. The rest of the funds, everything's fairly defined. Like, we're only going to hold Tesla and Tesla, right? So,
This is an interesting one, Jay. It seems that the only way to make money on these funds is to hold them as if they were an annuity. Big distributions, big drop in share price. Is that a fair appraisal?
I would look. Everybody has that is a use case here. By the way, I'm also a big fan of reinvesting the dividends outside of the cash that you need. Right, compound your shares as much as you can. But I don't know if these. I wouldn't call the YieldMax funds like trading vehicles because they are about earning time decay, right? So taking time the advantage of time out of them, and that's going to be distributed. Look, I would tell you that the inverse versions are probably more of, hey, I still want my yield, but I got bearish on a ticker. Let me flip to the inverse version for a little while, still earn my yield, and I could flip back to the bullish. I could see that as a use case. But I see other folks that use these as just like an additive, like, hey, I'm long a lot of Apple. Let me throw 20% in APLY. And now my Apple is paying me a bigger dividend, right? I mean, that's the whole case behind Berkshire.
Boost the dividend. Oh, because like Berkshire doesn't even pay a dividend.
Doesn't even pay a dividend.
Yeah,
right?
You're right.
So in that scenario, so I get, again, there's a lot of different use cases here. I could see that as, but again, I'm again, I think you've all heard me say this. I'm more of a fan of the drip, compound those shares, and it's more about the value in your portfolio than the price of the ETF, because the value in your portfolio, especially if you drip, is going to reflect the total return of your investment versus just watching the price of the ETF.
Yep. So I see this sentiment a lot. He says basically you can't use these as income. You have to use total return. Simple as that.
Again, if you want, you would invest in YieldMax because you want yield. You want alternative yield, right? You don't want traditional bond yield. You want alternative driven by volatility in stocks. And a lot of times when we talk about YieldMax stocks, and I do this all the time, we always reference the underlying, right? Like, oh, how do we do against the underlying? It's really not about the underlying, right? Who cares? The underlying is just the vehicle we're using to generate the yield. But look, sometimes you get a PLTY or an MSTY or even Coney where you've got all your money back before you know it in distributions, right? And then you're long, you're still left with the value there. So it's a use case thing, right? I definitely don't think it's, take 100% of the distributions out. It's never really our intention. We could have made the decision that a lot of, cover call ETFs do. Like you look at the old JEPIs and QILDs and JEPQs of the world, they don't give you all the dividends, right? The distributions they make from selling calls, they leave it in the fund. They make the decision for you to compound that investment. We decided to distribute and let the investor choose how they want to use it.
That's a big part of the weekly argument too, is that the investors say, no, I want it sooner so I can do the compounding myself. But so this point on the screen here, I think this is a fair point. He says, many of us use YieldMax to replace monthly income, aim for financial freedom. What realistic template do you suggest to reach this goal using YieldMax funds?
Yeah, I mean, that's a hard one to answer without knowing the individual, right? Who's talking about that. And I know that's kind of a cop-out, right? As an advisor, I can't give you advice on this. But here,
it's like when they say consult your tax advisor.
I get it. It's not the answer you're looking for. So look, I want to be able to give some guidance here, right? Again, if you are, taking all your money and putting it into an MSTY and be like, woo, I'm going to live off the distributions. Like that is, you still are taking stock risk, right? You're taking the risk that Michael Saylor doesn't get hit by a bus, or maybe his boat doesn't get sunk in the middle of the ocean, right? He has a few nice boats. Right? I mean, you're taking
diversification.
I mean, really, the name of his boat, this is public information, is actually Usher. If you look up his boat, you can look that up. He bought that in the internet boom, the first boom, right? So the boom. He's had this for a while. It's very impressive. Anyway, the thing that I would tell you here is, recognize the risk you're taking and then decide if that's the freedom that you want, right? Remember, you are taking stock risk when you buy an individual one of these. It's why I first tell like advisors, for example, start with YieldMax. Like YieldMax solves a lot of the diversification challenges that you may have. You take away the idiosyncratic single stock risk. But the other thing that I would tell you is look at if you want a higher distribution rate, although the distribution rate on YieldMax is pretty great recently, and you're getting those weekly payments. You can pick individual stocks that you think can have a sustained upside move, right? It doesn't even have to be upside, just have a sustained price. Like they're not taking a lot of risk. You like Microsoft? Great. You like Google? Great. You're telling me like you want to buy Carvana and use that to retire on the distributions and the dividends. Carvana's a volatile stock. That's probably not the direction I would go. So
it's
again,
been coming back this year though.
Yeah, no, Carvana's having a great year, but like I don't know if it goes up 100, it could go down 50 just as easily.
True.
That's all just regular stock movement. So I'm not an advocate of taking all your money, putting in YieldMax, and living off the distributions. I'm just not. That's just risky. I mean, but if that's a risk you want to take, just understand the risk you're taking. Like I've had people say, like, well, look, your distribution rate's 100. I'm gonna get all my money back and I'm safe in a year from now? Maybe, right? Maybe not, because as the stock is going down, a la Merni or Moderna, right? Even though we're paying at the rate that might be 100%, I think Moderna's rate was just 100%. You're not getting back. You're getting the rate for that period, right? So if the stock's cut in half, the dollars of your distribution are going to be half of your first distribution at 100 because the underlying has dropped. You started the show by going, hey, Jay, I heard a rumor Tesla just had its lowest distribution ever, right? So because the price of the ETF is down, yes, we're still distributing at a 50, I think it was like a 60+% distribution rate, but it's on a lower NAV price, right? So if you hadn't reinvested your dividends, you have a lower balance that you're getting the rate on, right? So that is another thing about protection against having a lower distribution, total distribution, meaning the full check amount, not just the per share amount, is by compounding the shares, you end up, having some stability in the amount of income you're earning. But then someone will be like, well, that's not income because you're telling me to reinvest it. Again, this is all investment strategies that are appropriate for each person. I have all the arguments. We're just giving you the tool here to make that decision. So I went off on that for a while. Sorry.
No, and I do see that a lot. And I call that the dividend paradox, by the way. So it's like, because the percentages are like 100%, they show up on a lot of screeners, and you might get lower information people that are saying, oh, look at this is 100%. Let me put a lot into this. I've done that myself. I did that with some oil stocks back in the day. And that's what happens. They're like, oh, 100%. But why? Like you said, because the share prices dropped 50%. Therefore, the dividend percentage is higher, even though the dollar amount might actually be the lowest that it's ever been.
Yeah. All right. So I saw the YOLOing. I think we just talked about Mr. Royalty, right? Like,
yeah. Oh, people are doing that. Absolutely. People are taking home equity loans and YOLOing into all of these funds.
It's just you're adding risk, right? Now you're adding leverage onto your risk.
Mm-hmm.
Every great sell-off had to do with leverage. Every great crash had to do with leverage.
That is true.
Yep.
All right. Pay the Piper says, please talk on LFGY and Chippy and these funds. Nice recovery since April. What's your delta on those calls? Is the fund rebalanced?
Yeah. Delta's decided based off of the income target on those. Those have been fairly stable, right? Income targets, right? LFGY is in the 60s, right? Chippy, I think, is probably in the 35s, right? Because there's a lot of more stable semis in that build. These are nice because, right, LFGY is crypto focused. Chippy is semiconductor focused, right? These are nice because, thanks for pulling that up.
Mm-hmm.
Yeah, it's pretty close, 63 and 39, right? So,
yeah.
So these are nice because you apply a theme. So this is like a combo of thematic investing plus, YieldMax approach for the distributions. Again, Delta is going to be a little different for each one of these. LFGY certainly has done fairly well. Both of them have done, well in the rebound, of course, since April.
Yep. And you've got like 9 weeklies now.
Yeah, I think they right. So the zero DTEs, the Alti, Chippy, GPTY, LFGYs, yep, those are in there. There's a funny comment in here from Emperor Palpatine. Do you see that one?
Oh, I've got to read that one because weekly, so daily would be the next, and there's a lot of people asking for that.
So think about daily, right? Like, and I'm gonna thanks everybody for your comments.
This is funnier, actually.
Yes. Roll Tide. We're Bama fans in my house.
Oh, really?
We are. Sorry for anybody if I insult. I know I live in Florida.
Is that just because they're like such a good team? I figured you'd be a fan of like some New York teams or something.
No, my brother was the captain of the Alabama swim team. So
really,
we're Bama fans. Yeah.
Interesting.
Call out to Jimmy Pestrichelli. Anyway, so thanks everybody for the zero.
Here it is. Here it is. I got to read
it. I'd love to hear your comments on this. So imagine this, right? You're getting dividends. So this is a funny request for dividends to be paid daily. It's almost, think about that. You're going ex-div every day, getting a payment, a day later, an announcement the day before. You probably just forgo the announcements at that point. So every day it's an ex-div. Think about this. Think about the confirms you're getting. Your broker probably can't even support this kind of distribution rate, right? So we'd be sending checks to your broker, lands in the omnibus. They have to pay you. You get confirms, right? Like it feels like a little bit of overkill. We have, a Title, which is the company I work for now, right? At Title, we have some clients that have said, yeah, what about daily? Where you don't know if it's even possible to pay daily, right? We just think the brokers will break. Like they're not set up for that kind of stuff. Plus the market would be really weird. So I'd love to hear if people are like, yeah, I want daily, weekly isn't frequent enough, or weekly is just fine. I'd love to hear.
Well, what I'm seeing some other fund companies doing, their funds are paying like on a different day of the week. So it's kind of like when you guys started doing the A, B, C, and D. So now you can get daily dividends if you're invested in all of those funds.
Yes, but for the individual funds, for sure, for the individual funds, it solves like you don't have a next date every day. You're going X, record date calculations and all that kind of stuff. I think people take for granted a little bit of the efficiency of the DTC, which is like the infrastructure that stock trading and clearing is all based on. It's archaic to a degree. It handles a ton of volume. Don't get me wrong, more volume than the blockchain can handle today. But don't even ask why I'm going there. But when you think about that kind of volume, it's just more, right? It's just a lot of moving parts that go along with distributions.
Mm-hmm. Okay, serious question. What collapses faster, implied volatility on Tesla or Hearts when you talk options flow?
That was the serious question?
He's a joker sometimes.
Yeah, no, that's good. Look, I think IV is, I'm looking at my chart on my other screens over there, right? I think implied vol, has a tendency to drift lower. We won't be out of it until I think we're past all of there's still that tariff, premium in volatility, add to the Middle East geopolitical. Geopolitical tension is usually reflected only for a short period of time in the markets. But you could get like a commodity move like oil, right? If that can change dramatically. But I think IV over time will drop. Like this is kind of the playbook though. Like if anybody had, if we had talked about this earlier on in the year, it was first half of the year is going to be pretty volatile as things kind of realign with, legislation that's passing. The second half of the year could be a fairly strong one. Like that is lining up. We're actually a little earlier than I thought, but that theory is lining up. I'm not sure if the Fed's going to cut or not. That adds to all of this here too. I don't think they have to right now. Like
I think other countries are starting to cut. So
yeah, but if we don't have to, that's okay, right? Yeah. I mean, it's okay to have a healthy 5% 10-year. Like there are plenty of years. One of the greatest bull markets, 94, 95 time period. Interest rates were 5%. It was fine. 10-year was 5%, right? So it's okay. It's not really that restrictive right now. I'd rather they leave the bullets in their belt for when we really have a problem. But
I agree. Yeah. I was worried about that in 2020 when they cut basically to zero. I'm like, so if the market doesn't recover, they're out of bullets. But then it did. Yeah.
Yeah. The daily dividend question here, I was even talking about expenses, right? It's just functionality. Yeah, it is. By the way, when you move to weekly versus monthly distributions, right, you've quadrupled the amount of work it takes to do that you're spending there. So
I thought it was funny. He says like a tariff on daily dividends.
So yeah, so we'll just have a higher premium on some funds.
Mm-hmm. He likes to talk about tariffs a lot. He says, any concerns about the tariff?
I think there'll be some volatility around that for sure. Yeah, I mean there will be. It's right. You get these ticker bombs, meaning news headline bombs that just crush the markets in a very, very short period of time. it's not all going to go, swimmingly. So yeah, that's not a bad time to be hedged around. Hey, use YQQQ if you want. If you're
That's true.
If you're bearish.
EQQ and YQQQ. Yeah, I'm in both.
Yeah.
What are your thoughts, by the way? So I do this. Not everybody's like this sophisticated. Not saying I'm super sophisticated, but like I do the wheel strategy personally to generate income on top of YieldMax, and it's actually been going really well. What are your thoughts on that?
Sure. Are you saying you're using a YieldMax ticker but doing the wheel approach? So for those that don't know what that is, right? You're long stock, or let's say you're long nothing,
or you just
sell
do the puts to get into it at the price you pick.
Right. You sell a short put, you get some income, and you just keep doing that, making your income. And then if the stock drops, you get assigned the stock. Now you're long the stock, and now you sell calls until it gets assigned and called away. Yeah. So this is known as the wheel tactic. Mm-hmm. Look, there's it can work, it cannot work, right? Wheel breaks down, you're still ultimately bullish the stock, right? Still ultimately bullish stock. The wheel breaks down. Let's say your stock's 100, you're selling 90 puts. Stock gaps down to 80. You buy at 90. Like that was the put you sold, so you bought at 90. So now you're at minus 10. Stock proceeds to go down 80, 70, 60. And meanwhile, you're selling strikes all the way down. So while it's trading at 60, you sold the 70 call. Well, guess what? As it rockets back up, you now sold at 70, right? You got called away at 70. So in all of that scenario, you bought at 90, you sold at 70. So that's a minus $20 transaction right there. So you have to hope the income you've made along the way offset that. That's when the wheel breaks down. In a bullish move, you also are only capturing the puts, the put income, right? So if you're doing it for income, you're only getting the extrinsic, the time value. You're getting no upside capture of, up to the strike of the call. So, look, it works. It can work. Don't get me wrong, but there's some downsides to it. It's not a tactic I was ever the biggest fan of because of those two scenarios that I just laid out. So if you were doing that with YieldMax, it's a little different because you are getting paid, notably higher distributions. But as we all know, the NAV tends to decline. So you need to be fairly active on resetting where that put strike is going to be and your sizing. So it's even harder to do with a YieldMax ticker.
I've actually, and I don't recommend this for everybody, I've been doing them on leveraged ETFs. And they've been making good premium, but you're right, they have to move. If they move the other way, then you're either rolling for a loss or you're getting assigned. Okay, how are you on time? We still have a lot of questions.
Yep, I can continue. Let's keep going.
Okay, so for Misty, he's mentioned max 15% allocation per ticker. Can you allocate 15% to MSTR?
I don't know what passive investing is referencing here. For Misty, I've mentioned 15. Oh, like personally?
Yeah.
Personally, but I'm not sure. Did I really ever recommend 15% allocation to Misty?
You probably, in everything you've said, somewhere along the lines.
Yeah, I could have said that somewhere. Yeah. Again, it's your risk tolerance, right? But then it says, can you allocate 50% to MSTR shares? I don't know if that's within the fund or not. We now know we can with the prospectus, but it's not something we're doing right now. So I'm sorry, I don't fully get the question. Apologies here. Is it in Aldi? I don't know what that is.
Maybe he can ask it again. Hoff wants hourly dividends.
Yes, me too. It'd be awesome.
So he says, I guess some of us have to ask the tough questions. The strangles on alpha stocks will remain an issue unless the conversation takes place within the team. Why avoid it?
Okay. Strangles, I'm assuming we're talking about Alti here, right? That's one of the only tickers where we could do strangles, right? Or LFGY or Chippy. Again, it's defining what your initial goal is on these, right? So yeah, it's where you're selling calls and puts. You could either be selling them, so there's a straddle and a strangle. They are very similar. The only difference is either everything's at the same strike or you spread them out a little bit and you're selling calls and puts for income on both sides. I think that's where he's going with the strangle piece. Well, what I would say, it's an absolute, we talk about backtest. So we have backtested the bejesus out of that one. And the challenge there is most of your trades actually, when you distribute the income you made, the time premium, which still can be positive, don't get me wrong, all that's left is losses, right? So if you were to distribute, you'd have to not distribute all of the income you made from selling those options. And so without losing too many folks that are still here, I would say, it would have to be a modification of how much you distribute. You'd have to keep you'd have to hold something back, because even like we did a test on this on the S&P, right? One of the least volatile that there was. And yeah, you take a look at doing dailies here and you're up, 7, 8, 9% against the market, but the NAV declines by something like 70, 80%, right? It's just not palatable as a product. So we've looked and we've decided not to do it. By the way, there have been other firms that have filed for straddles and strangles on regular or even leveraged ETFs or stocks or leveraged stocks. And none of them have gone live because I think they all ended up figuring it out.
Aloha NY says, last time we requested weekly dividends, you went ahead and did it for us. Thank you. Now we're getting greedy. We already asked this. Just thought I would read it, though.
I mean, there's always a chance.
Right. Apparently.
If the regulate, I think it has to have, every broker's got to support it. I mean, not everyone, but all the major brokers have to support this kind of thing. I'm not sure what the likelihood is.
That's true. It's going to take maybe some advent on the broker's part.
Yeah, they'll have to change. Again, I'm fairly certain if we told Schwab or Fidelity, hey, we've got daily distributions, they'll be like, no, you can't buy this on our platform anymore. There's a real chance of that.
I'm so glad you mentioned that. That was a question I had. So, Schwab stopped displaying most of the YieldMax dividends. And I called them about this because it was really frustrating, because that bar chart of month-by-month dividends was perfect for my viewership and for my videos. And now it's not showing Tesla. It didn't show Coney all last year and several of the other ones. And so I called them and they said, basically, and I was surprised, and I want to know your thoughts on this. They said, well, the dividends are too unpredictable for us to estimate what they're going to be.
It's not false. We know it's based on volatility, right?
Yeah.
MicroStrategy, right? When we first started trading MicroStrategy and MSTY, the vol was 200. Right now it's in the 50s. It is unpredictable. We all know this. That's why those weekly notifications are so subscribed for. The open rate on those emails is huge because it could change. It's not stable. If you've recognized, Alti, LFGY, Chippy, they've been fairly stabilized because it's so hard. Those don't trade weekly. We don't trade weekly in those, but we want to have the weekly distribution. So we have to kind of, while we're setting a target to get to, it doesn't always happen within the week, right? Mm-hmm. So those are a little more stable on the distribution rates. But you're right, Tesla can move around quite a bit. Absolutely.
If someone was trying to estimate the dividends themselves, what would you recommend? Just follow the trades daily and capture the wins and losses?
Well, look, there's some folks that do that, retire on dividends, right? They'll tell you what we do every day, and more power to them. I would say, if you just wanted to know, hey, what should I expect from NVIDIA, right, or NVIDIA? Look at the implied volatility. I know I'm a broken record, but that's the answer. I'm giving you the answer to the test. Now, there are times where we may exceed that distribution rate because we've had a large upside capture. Maybe we rolled the synthetic and it yielded profits, right? And we know we're going to have to distribute those profits. And so we may distribute some of that. But the base case is always the IV.
Right. I don't know how much of my videos you watch. I do that, but I have other methods to predict.
It's the perfect. That's it. What's it say today?
It says the dividends are going to be great. Yeah.
Paid for by YieldMax LLC. Yeah.
Maybe. Let's see here. Since reverse ETFs don't offer a true one-for-one hedge, what strategies can we use to offset portfolio losses? Are you planning to launch any hedging-focused ETFs beyond just inverse funds?
Yeah, this is a great question. So you're, first off, 100% correct. Buying an inverse doesn't necessarily hedge the bullish version of an ETF, right? So buying Misty and buying Winter, or buying Tesla and buying Crash, not necessarily going to offset each other. They may not. In big moves, they will not. Like dramatic, when the market has more like a, let's call it, here I'll geek out for a minute, like a 2 standard Eve move, meaning it's moved twice what the volatility expected to move. In that scenario, you're not going to be hedged, right? Yes, you'll have lower volatility in your portfolio, but you're definitely not going to be hedged. Okay, so how can you actually hedge? At that point, now you got to be a put trader, right? You got to understand buying puts or put spreads in order to understand where your risk lies. Again, there's a lot of factors that go into that. You could buy puts on the underlying, or you could buy puts on the actual YieldMax ETF. There's plenty of volume in a lot of the ETFs now, option volume, I should say, that you could actually buy hedging there. It would be interesting to go through like kind of an exercise there. I think generally, right, you've decided to take single stock risk when you bought an individual YieldMax single stock ETF, right? So hedging the market isn't the best way. If you're going to do YieldMax, YMAX or YMAG or SDTY or QDTY, you're going to do any of those. In those situations, what you should look at is you could use an index as a put. But otherwise, I would say stick to the individual stock, buy puts on the stock. But then at that point, you got to look at what our exposure is. So look at the portfolio to know where it makes sense, or just buy the puts on the ETF, because the market makers that put the pricing out on, NVIDIA, Tesla, Misty, Coney, right? The market makers that are putting the markets out and the options for those have already done that work, right? They don't want to find themselves on the wrong side of a trade. By the way, they don't even get the dividend distributions accurate, right? Because it is unpredictable. So that's the only other way to do it. So then the last one, are you planning to launch any hedge-focused ETFs besides the inverse? Nothing has been filed. Looking at adding in puts and maybe collaring besides the Chippy Ulti, GPTYs, LFGYs of the world, which do use puts to hedge. So there is hedging in those. Like right now, I think we have a fairly substantial hedge in LFGY on Bitcoin, for example, right? Outside of that, talking about the single stocks, we've definitely considered, and we haven't been sure if people would understand a collar or not, right? So it's we do it. Almost every one of the Ulti positions are collared, right? So as we were talking about before. So we do a little bit of it now. It's definitely something we considered. Be interesting to hear if people want that. Like, and if they did, how much of a hedge would they want? Is it a -20? Is it a -5? Right? Do you want a pure buffer? Ugh, those are not always great, but it'd be interested to hear that feedback there. Thanks. That's a good question.
So he wants to know, who do you want to play you in the YieldMax biopic?
Yeah, I mean, I think it has to be somebody, who's almost as handsome as me. Well, yeah.
So barring single stock strategies, I urge you to clarify whether YMAX or zero-day expiration can realistically support the financial freedom goal, especially since Roundhill promotes lower drawdowns and consistent 25 to 30% returns.
Yeah, I think if you look at the zero DTEs, I think the returns on YieldMax are slightly higher, right? That might be deliberate. And then the returns there are similar. So I don't think, I think that we are looking at that. Again, the lifestyle question, I think we spent a lot of time talking about that one already. But I like the diversification of all of those as a core holding. Like, I wouldn't have a problem with any stock allocation, like stock level risk allocation, having a YMAX or an SDTY in the portfolio, because that's like in your alternative strategy, right? But I wouldn't have a problem if there's if that's included in the core holdings. Not everybody it's not appropriate for everybody to hold Misty, right? You got to have a theory on MicroStrategy itself. But if you're investing in equities and you're willing to take equity like risk, it's fine to have an allocation in those, in my mind, for sure. It should be part of it. It should be.
Yeah. So this week, anything you did to capture upside on Coney?
All right. So yes, there were. We used the call spread tactic, right? So I think 2/3 of the position in Coney had call spreads versus just short calls. I think everybody at this point realizes we use that as a tactic now to not find yourself flat-footed when you get a plus 20% move in a single day. There was a 20 or 25. Like, that was a pretty big move with the the legislation that was the stablecoin legislation. I think it was called the Genius Act. That was, we were fairly well positioned. I think, we could have been a little more, bullish biased on that one. But again, you don't know how these things are going to go. So interestingly, though, right, didn't impact MicroStrategy very much. But by the way, I think that makes sense, quite frankly, right? This was a stable coin, not a Bitcoin piece of legislation. And so I think, we were able to do that. By the way, we rolled intraday, like as that was happening throughout the day. I think we probably rolled the next day too, right? So I don't want to give too much away, right? So we were just actively managing and looking to capture as much upside as we can. I think we did a fairly good job of capturing the majority of the upside, though.
Mm-hmm. Here's a kind of different topic here: the 5e and FEEP funds. Can you explain the strategy on
Yep. So these are two fund of funds where they hold 5 YieldMaxes. One of them holds 5 YieldMaxes. One of them holds 5 YieldMaxes and the 5 underlying long stock. So this was a result of people saying, Jay, can't you just tell us which one I should buy? Right? Like we were hearing a lot last year about just tell me the best ones I should own. And it's not, I told you, we're not making market calls here. So we partnered with Dorsey Wright, which is kind of well known as a momentum, a firm that specializes in a momentum indicator, a series of momentum indicators. And we said, hey, Dorsey Wright, here's our list of YieldMaxes and the underlying tickers. Pick the 5 each month that have the greatest chance of upside move based on your momentum indicators. And so FEET, which stands for featured, the 5 featured funds, it just holds 5 YieldMax ETFs. And then in FIVI, which is I guess I can't remember exactly the logic behind that one. I think it was so it's featured plus it's a hybrid of long stock. It holds 60% of the YieldMax and 40% of the underlying ticker, right? So it'd be a 60% MISTI, 40% MSTR for that 1/5. And so that's the idea of these, is to have some momentum based upside capture by fund selection, underlying stock selection.
Yep.
If you want a little momentum and you want a little input from one of the best momentum players on the street of Dorsey Wright, that's why we partnered with them.
Mm-hmm. Let's see. Single ticker plus SP is a foundation of maybe 50% of an ETF. Would that help? Something similar to what SFOL has done lately, he says.
Yeah, SFOL has a mix of positions, right? It's not always just short, VIX futures and long VIX calls, right? It definitely has a different mix. So single stock plus the S&P as a foundation. Yeah, look, this is a preference. This is why you can build this yourself, right? So to me, it's, pick the tickers that you are, you have a bullish inclination on. If you're bearish a YieldMax single stock, you should not buy it, right? Some folks are like, oh, cover calls, you make money on the way down. No, it just means you lose less on the way down. You're still losing because you're long stock. I would say, of course, this is viable for your stock allocation. And if you're only trading stocks, great. I think that's okay. I probably wouldn't have 50% again, that's way too concentrated in my opinion, right? Anything past 20% is fairly concentrated in a single ticker.
Mm-hmm. So going back to a subject I know we've kind of beat up a lot, but similar topic. As an example, the first time a YieldMax user gets a dividend, they receive a huge yield, but their NAV reduced by the amount of that dividend on that day. Have they made any money?
You don't make any money just from the distribution of the dividend. It still has to do with the underlying, right? If an ETF is trading at 50 and we distribute $1, you will then have an ETF at 49 and $1 of cash in your pocket, right? You're still worth 50. So no, there's no buying an ETF right before the distribution, unless your goal is to actually get the cash. You're not creating, I know that sounds weird. It's like, yeah, we all want the cash, Jay, but you're not really creating any additional value at the time of that ex-div. By the way, there's a day difference between when you get the cash and it goes ex-div. It usually goes ex-div the day before you get the cash. But that's not the case with a lot of ETFs, by the way, right? Some ETFs, you got to wait 2 or 3 weeks. On stocks, you got to wait 2 or 3 weeks. We have accelerated that to the best we can to be the day after ex-div, because you don't really know the final numbers, share counts, and all those kinds of things to come up with the actual distribution rate. But no, you don't actually add any value, but you just converted some of your ETF NAV to cash.
Mm-hmm. And then this is kind of like a part 2. At some point, you have to take income unless you have reimbursed your basis with at least 1.5 years of dividends. Then you technically don't have new money, he says.
Okay. Look, it's still eventually, yes, eventually you have to take some income. I get that. You could have your full basis reimbursed if you're using that as like, hey, my dividends paid for my amount that I originally paid. Like if I paid $20 to get in and I've got $20 of distributions, right at that point, you still own an ETF that's got value, but you've already got $20 of cash, right? Which, by the way, has happened on more than one occasion. I think it's happened 4 times so far with these. And remember, we're still fairly new, right? I mean, Coney did it in 9 months. I think you had got 100% of the initial listing price back. Misty has definitely done it. NVIDIA has done it. If Palantir hasn't, it will soon, right? Like, this is this definitely can happen fairly quickly with at least 1.5 years of dividends. Yeah. So a lot of them, 1.5 years is definitely possible, right? What's the rate that you have to have your distribution? And that's 67%. But that doesn't account for the change in the underlying ETF NAV. Yeah. So new money, I guess when you're talking technically new money or having growth or like, oh, I have excess cash from what I started with, you can always close the position, right? And then you would have more if there was growth from total return being positive. Of course, I think you know that. But you're right. If you at some point be like, oh, now I've reinvested my allocation. Let's say you started with $10,000 and you've done the drip and you kept it at, it's going to go up and down, but the $10,000 is still there. And you look at how much you got in distributions, right? Actually, at that point, you'd want it to be higher than 10,000. I think that's what you're asking. There's a little more of a timing of when to start taking dividends. But look, I don't think it's wrong that people take 4 to 8% of the distributions for cash. I think that's acceptable, right? I think that should at least be expected by most folks. I'm not telling you should do that. I told you if you're in growth mode, then you should reinvest all of it. If you're in time for me to take some money out of my account, standard, advisor logic would tell you 4 to 8%. It's probably the right range for you to take out of your portfolio.
Mm-hmm. He said he really wants you to have a conversation with the trading team on managing the alpha stocks and Alti.
I wish you had said something earlier, Earth. This is the first time I'm hearing of it.
You already had your meeting, probably, for the day. Yeah.
Actually, they're outside my door. They're hearing everything right now. They are literally. Yeah.
Yeah. Great. Let's see. I think we asked this already.
Yep, we did that one.
Let me scroll back down to the bottom. I was trying to go through other ones here that we got. What use cases are you hearing from customers nearing retirement who are considering YieldMax for income? What advice are you giving to those facing a retirement crunch amid inflation and uncertainty?
Yeah, so I think the numbers I just kind of gave make sense if someone's like, let's be realistic, right? Let's pretend there was no YieldMax in existence, right? And all of a sudden you have a long portfolio. If your expectation is, I need to take 10% out of my portfolio every year, you're probably going to chew into the principal way more than you want to, right? That's not realistic. If someone came to you and said, here's my $1 million, but I want to take out $100,000 a year, can you maintain that? I wouldn't make that promise to an investor, right? As an advisor, I wouldn't do that because you don't know, right? You could get a period of declines and you have this this thing that the timing of your withdrawals can be really damaging, right? It can hurt you because you're taking that money out. Like, let's say you had $1 million, you took out 100,000 and the market was flat. Now you're at 900,000. Okay. That makes sense. If the market went up, let's say 10%, I'm using average numbers. I know it's not exact. You'd still be like, ooh, I'm still at my $1 million and I got 100,000. But if the market goes down 10% and you take out 10%. Now you're sitting at $800,000, right? And you're like, okay, I now have to make, quite a bit of money to make that 20%, 25% gain to get back to that 100,000. Oh, in the meantime, I know I'm going to take another 100,000 out, right? Like that gets very, very difficult. So that is investing in general, right? YieldMax hasn't changed the laws of investing. Yes, we generate a lot of cash and make it very easy to take the cash out. But if the market is down for a period of time, you're going to have that challenge where your underlying tickers are just going to decline, right? If you had a portfolio of Murneys, I hope nobody ever had that, right? As we talked about earlier, and everything was just down 75%, you can't take more out. So it's be conservative on what you can take out, understanding what your growth looks like and understanding the risk. Okay, now I've said all my disclosure stuff. So I generally tell people invest in the market. It generally goes up. Yes, you'll have periods of declines, but I would not be surprised if by the time this year is over, we have seen new all-time highs.
I agree.
All-time highs fairly regularly. The market trades within 3% of an all-time high more than half the time, right?
Yep.
It's always pressing and pushing higher. So invest. Don't time the market. I know that's not what you're asking, but I would say, take out that rate that you can withstand a period of 3 years of declines and not find yourself in an unsurmountable appreciation where you have to get back. Look, we were lucky and not lucky. The market was very successful in 23 and 24, right? That was a very nice appreciation period. You don't get 2 plus 25s in a row all the time, right?
Right.
That helped a lot of people recover. 22 was ugly. 25, the jury's out. But like I said, I still think there's a decent chance we touch all-time highs before this year is over.
We had, with the exception of 2018, 2017 was great. 2016 was great. 2017, 19, 20, and 21, despite COVID.
Sure. Yeah. So just stick with it, right? Like don't let the market, if you're in retirement, don't let the market volatility change your plan. Have a plan that can withstand some of that. And if it's taking out 4 to 8%, great. YieldMax is definitely a way that can meet just the cash generation aspect.
Real quick, so we did address this in the beginning. It's only on 2 funds so far. Is that correct?
Have we asked if the new strategy of owning underlying spreads has been implemented? Okay, so owning underlying and spreads have been implemented. So no, we have not implemented owning long stock in any of the single stocks. In the basket stocks, as I call them, like the Altis, Chippies, even the Soxies and Biggies of the world, yes, we own stock there and we do spreads. But in single stocks, we haven't implemented any of that yet. And we don't, it was more of a change in the filing in anticipation of potential size position limits implemented by the OCC. We didn't want to be caught flat-footed when they cut the the MicroStrategy and NVIDIA position limits by, to 1/10 because of post their split. So we're just trying to get ahead of that. That was it.
So in the interest of time, we may just have to email you some questions that we can't get to.
Okay, that's cool. Yeah, no, we're going an hour and a half here, right? So
yeah.
Thanks everybody for still staying.
One silly one, I guess. Do you plan to attend the Bitcoin conference meetup? Apparently there's one.
I didn't know they were doing one. So maybe if you told me, I might go.
Yep.
I'm not the Bitcoin guy, right? I'm the options guy.
Right.
Sure we got a Bitcoin guy that can go.
Right. Update site daily to show projected dividends.
Not going to show projected dividends. You can project the dividends based off of looking at the implied volatility. Can't really give an indication of forward-looking dividends. The SEC, not Alabama, frowns on that.
Retiring dividends says, where's Scott?
Kind of let that guy take a vacation. Did you see a little less trading this week, retiring dividends? Actually, he was still trading while on vacation, so you can't get that guy away from it.
Yeah. All right, so I'm going to take the best questions left and just, I guess, email you, or maybe we can do a sooner follow-up or something.
Yes, we'll go sooner than 3 months next time for sure.
Yeah, yep. Sounds good. Okay, let's see. Yeah, so that's, we got a lot covered today. He said, yeah, I do this actually. I do the underlying and distributions.
Yep.
So, yeah.
That's definitely a tactic. We definitely see that a lot.
Mm-hmm. All right. Well, thanks so much again, Jay, for coming on. Any last words to the audience for this one?
No, just appreciate the support. Thanks, everybody. You guys were early adopters on YieldMax. And so just know you're part of the original community here. So thank you. And I always appreciate being here. Appreciate the support. And Coach, I will see you in 2
New
weeks.
York. Yeah, we're going to be on the NASDAQ for anybody that doesn't know. Yeah.
Watch the closing bell on July 11th to see us in person.
That's right. Yep. All right. Thanks again, Jay. And we'll
Thanks, everybody.
Yep. All right. Bye. And then for those watching, please remember to like, comment, and subscribe and join Discord. Check out YieldMax, and we'll see you all in the next one. Take care. Bye.